Good morning. Today is January 9th, 2026, and I need you to understand something very clearly. The silver rocket has officially launched, and it's highly probable, almost certain, that we're never going back to $70, $72 prices. My name is William Lee, and today I'm going to explain exactly why silver took off, what happened in the last 48 hours that changed everything, and why you need to make a decision right now about whether you're getting on this train or watching it leave the station without you. Let me show you something critical that happened yesterday. Look at this chart very carefully because what you're seeing is not just random price movement. This is the market speaking in a language that very few people understand. But I'm going to translate it for you so clearly that you'll wonder how you ever missed it. Yesterday, during the London trading session, silver corrected down to $74 per ounce. Now, if you were watching CNBC or listening to the Perma Bears, you probably heard silver crash, the rally is over, time to sell. But that's not what happened. What actually happened is one of the most bullish technical setups I've seen in my entire career. The market was filling a gap, a massive gap, an enormous hole in the price structure that was created by a giant bullish candle that moved so fast it left empty space behind. Let me explain this for those who might not be familiar with gap theory. When price moves violently in one direction, and we saw silver jump from $72 to $83 in just days, it creates what technicians call a fair value gap, or FVG. This is literally empty space on the chart where no trading occurred, no equilibrium was established, no buyers and sellers met to agree on value. The market hates these gaps. It needs to fill them. It's like gravity for price action. The market will almost always return to fill these gaps before continuing in the original direction. And that's exactly what we saw yesterday. The London session took silver down to $74, perfectly filling that 4-hour fair value gap that had been sitting there like an open wound on the chart. Professional traders who understand market structure were not panicking, they were celebrating. Because gap fills in the middle of strong uptrends are gifts. They're opportunities to add to positions at better prices before the next leg up. But it gets better, much better. After London filled the gap at $74, the New York session closed around $77 per ounce. And right now, as I'm recording this on the morning of January 9th, we're almost back at $80. The train has left the station, the rocket has launched. And we're probably heading straight to $84, which is the next major resistance level. And when we break $84, not if, but when, we're going to $100 per ounce faster than most people can react. Now let me show you the technical analysis that confirms this isn't just hopium or speculation. This is mathematical probability based on price structure, Fibonacci levels, and volume analysis. If you look at where silver bounced yesterday, it wasn't random. The low at $74 corresponds perfectly with not just the fair value gap, but also with the 61.8% to 78.6% Fibonacci retracement levels of the entire move from $70 to $83. For those who aren't familiar with Fibonacci retracements, these are mathematical ratios that appear throughout nature, in seashells, in galaxies, in DNA spirals, and they also appear in financial markets with uncanny accuracy. The 61.8% level, often called the golden ratio, is where the strongest trends tend to find support before continuing. When price retraces to this level and bounces, it's one of the most reliable bullish signals in technical analysis. Silver hit the 61.8% retracement almost perfectly, bounced hard, and is now resuming the uptrend. This is textbook bull market behavior. This is what you see in assets that are in the early stages of multi-year bull runs. The weak hands get shaken out at the retracement, the strong hands accumulate, and then price explodes to new highs, leaving everyone who sold at $74 wondering what just happened. But the Fibonacci confluence isn't even the most bullish part. The most bullish part is the volume. Look at where the volume was highest during this correction. It wasn't on the way down, it was on the way back up. This tells us that institutional buyers were waiting for this pullback. They had limit orders sitting at $74 or $75. They accumulated massively at those levels, and now they're pushing price back up with conviction. Volume analysis is critical in commodity markets because it tells you who's really in control, the buyers or the sellers. When you see price drop on low volume and then reverse on high volume, it means the selling was weak and the buying is strong. It means the correction was a liquidity hunt, not a trend change. And that's exactly what we're seeing in silver right now. Now, I need to address something because I know what some of you are thinking. Bill, couldn't silver make one more correction down to $70? Isn't that still possible? Yes, technically it's possible. Markets can always do one more shakeout. But here's what you need to understand. The probability of that happening is much lower than the probability of silver continuing straight to $100 from here. Why? Because of what's happening on the fundamental side. And this is where we need to talk about China and Japan, because what's happening in Asia right now is absolutely unprecedented. While you're sleeping, while the Western markets are closed, while American traders are having dinner or watching TV, The Asian giants are inserting billions and billions of dollars into silver every single night. For several weeks now, the highest volume trading sessions have been the Asian sessions, not New York, not London, Tokyo, Shanghai, Singapore. The giant has awakened, and this giant has looked at the situation, the devaluing dollar, the printing press that won't stop, the $36 trillion US debt growing by $1 trillion every 100 days, and they've made a decision. They're converting their fiat currency into hard assets as fast as humanly possible. Let me give you specific numbers because this is not abstract. This is documented, measurable, undeniable reality. In the last month alone, based on delivery data from the Shanghai Futures Exchange and the Tokyo Commodity Exchange, Asian buyers have taken delivery of over 150 million ounces of physical silver. That's nearly 20% of annual global production consumed by Asia in just 30 days. China specifically is operating on a scale that dwarfs anything we saw in previous cycles. Their M2 money supply expansion of 48 trillion yuan is not going into real estate anymore. It's not going into tech stocks. It's going into commodities, silver, gold, copper, rare earths. They're executing a strategy that was planned decades ago. Convert paper into atoms before the paper becomes worthless. And Japan is following the same playbook. Look at silver prices in Tokyo right now. Over $120 per ounce, not $77 like New York, not $80 like London, over $120. This is telling you that physical silver in Japan is trading at a 50% plus premium to the COMEX paper price. Why? Because they can't get enough physical metal. The demand is so intense that they're willing to pay massive premiums just to secure supply. This creates what economists call a regional pricing divergence. For decades, silver had one global price. Whether you were in New York, London, Tokyo, or Dubai, silver was roughly the same price with maybe $1–2 difference for shipping and local premiums. But that system is breaking down right now. We're entering an era where different regions will have drastically different prices for the same commodity based on local supply and demand dynamics. In Japan, 120 plus, in UAE, 110 plus, in China, 100 plus, in COMEX. 77 bas, this spread is not sustainable. Arbitrage traders would normally step in, buy from the cheap market, sell to the expensive market, pocket the difference, and close the gap. But they can't. Why? Because China implemented export controls effective January 1st, 2026. Physical silver cannot freely leave China anymore without government-approved licenses, and China is only giving those licenses to about 40–50 CCP-linked exporters. This is nationalization, Chinese style. They're not officially nationalizing the silver industry, they're just controlling who can export it. And by controlling exports, they control global supply. And by controlling global supply, they control price. This is economic warfare at the highest level, executed with precision and patience. Lior Gantz from Wealth Research Group, one of the smartest commodity analysts I know, explained this perfectly in a recent interview. He said that what we're witnessing is the end of the fake global price for silver. We're liberating silver to discover its real price based on regional circumstances. And the real price, in places where people actually need the physical metal for industry and where they don't trust paper promises, is 40–50% higher than the COMEX says it is. Now let's talk about why this matters for your decision right now. Because you're at a crossroads. You can either understand what I'm telling you and position yourself accordingly, or you can doubt it, wait for confirmation, and miss the move entirely. Let me be very clear about what's coming. Silver is at 77.80 right now. The next major resistance is 84. That's the level we touched briefly before the correction. It's the all-time high from the recent move. It's the psychological barrier that every trader in the world is watching. When, not if, but when, we break $84 with conviction, with volume, with follow-through, here's what happens. Every algorithm that's been programmed to buy breakouts flips bullish and starts buying. Every hedge fund that's been sitting on the sidelines waiting for confirmation jumps in. Every retail trader who sold at $74 tries to get back in. Every industrial user who was hoping for lower prices panic buys to secure supply. All of this buying pressure hits simultaneously, and there's no supply to meet it because the COMEX vaults are nearly empty. China isn't exporting, and mines can't increase production overnight. This creates what's called a supply-demand mismatch at a critical technical breakout level. The result is a vertical move. We're not talking about silver grinding up $1 per day. We're talking about silver gapping from $84 to $92 overnight, from $92s to $100 within days. This is how commodities move when they're in the early stages of supercycles driven by both technical and fundamental factors aligning perfectly. And the evidence that this is coming is overwhelming. Look at the COMEX delivery data. In January, which is supposed to be a quiet, non-delivery month, we saw 23.5 million ounces stand for delivery. in just 72 hours. That's unprecedented. That's a bank run. That's proof that the big players don't trust the system anymore. They want physical metal in their possession, and they want it now. JP Morgan, which has been the custodian of COMEX silver for decades, was forced to issue delivery notices. JP Morgan doesn't issue delivery notices. They take delivery. They accumulate. They hoard. But now they're being forced to cough up metal because the demand is so intense they have no choice. This tells you the vaults are under extreme stress. They're scraping the bottom of the barrel. Registered COMEX silver inventory, that's the metal available for delivery, is down to about 120 million ounces. At the current delivery request rate, that inventory will be zero by the end of January, 3 weeks away. What happens when COMEX registered inventory hits zero? They declare force majeure. They cash settle contracts. They tell people, sorry, no metal, here's a check. And the moment that happens, paper silver becomes worthless and physical silver gaps to 150 plus overnight as the market reprices based on actual scarcity rather than paper promises. This is why I'm telling you we're probably not going back to 70-72, because the people who understand these dynamics, China, Japan, the Middle Eastern sovereign wealth funds, the smart institutions, they're not selling at $77. They're buying. Every dip gets absorbed by massive institutional buying. The floor is rising. What was support at $50 is now support at $70. What was resistance at $80 is about to become support at $80. Let me show you the technical roadmap so you understand exactly what to watch for. Right now, we're in a consolidation zone between $76 and $80. This is normal after filling the fair value gap. The market is digesting the move, resetting indicators, preparing for the next leg. The RSI on the daily chart has cooled off from overbought territory. The MACD is setting up for a bullish cross. The moving averages are all pointing up in perfect alignment. Everything is coiled for the next explosion. The trigger is $84. That's the line in the sand. When we break $84 with a daily close above it, preferably with high volume, that's your signal that the next leg has begun. From $84 to $100 should take about a week, maybe less. It will be violent. It will be fast. You won't have time to think about whether you should buy. By the time you decide, it will be at $95 and you'll be chasing. From $100 to $120 another week or two. This is where FOMO kicks in massively. Every financial news outlet will be running stories about silver. Every retail investor who ignored it at $70 will be desperately trying to buy at $110. The premiums on physical coins will explode to $20, $30 over spot because dealers can't keep up with demand. From $120 to $150, this is where we potentially see the COMEX default scenario. If they can't deliver metal in the March contract cycle, if they're forced to cash settle, the price will gap massively overnight. You could literally go to bed with silver at $125 and wake up to silver at $155 with no trades in between, just a gap. This is what happens when paper markets die and physical scarcity becomes the only reality that matters. And beyond $150, that's where we enter true price discovery territory, because there's no resistance up there. Nobody bought silver at $140 in recent history, so there are no bag holders waiting to sell. It's blue sky. The only limit is how high buyers are willing to bid before mines can increase production, which takes years, or before industrial users start substituting other materials, which is almost impossible for most applications. Some analysts are calling for $200 by mid-2026, some are calling for $300 by year-end. Andy Schechtman from Miles Franklin recently said he wouldn't be surprised to see $400 to $500 silver if the monetary system breaks down completely. Are these numbers crazy? Maybe. But they're not impossible. When supply is constrained and demand is unlimited, price becomes meaningless. It's just whatever the last desperate buyer is willing to pay. Now let me address the psychological barrier that's probably in your head right now. You're thinking $77 feels expensive. I missed the move from 25 to 77 as I should wait for a pullback. This is the most expensive mistake you can make because you're anchoring to where silver was, not where it's going. If silver is going to $150, $200 over the next 6-12 months, then the difference between buying at $70 or $77 is completely irrelevant. It's like worrying about whether you bought Bitcoin at $10,000 or $12,000 when it went to $69,000. The entry point doesn't matter in the grand scheme if you understand the destination. And here's the brutal truth about waiting for pullbacks. They might not come. Or if they do, they might be so brief and violent that you miss them. Look at what happened yesterday. Silver dropped to $74 in London. By New York close, it was back at $77. That's a 3-hour buying window. If you weren't watching the market every minute, you missed it. And that might have been your last chance to buy below 75. The market doesn't owe you a comfortable entry. The market doesn't care about your feelings or your hope for lower prices. The market goes where supply and demand take it. And right now, supply is constrained and demand is exploding. That equation leads to higher prices, period. Let me give you the fundamental reasons why $72 is probably gone forever. First, China's export controls are permanent. They're not lifting them. This is part of their long-term strategy to control strategic resources. Second, COMEX inventory is structurally depleted. Even if they avoid default in January or March, the trend is clear. Metal is flowing out, not in. Third, industrial demand is increasing, not decreasing. The green energy transition, AI data centers, 5G expansion, military modernization, all require massive amounts of silver. Fourth, mine production is flat or declining. It takes 10 plus years to bring a new mine online. Even if silver goes to $150 and incentivizes new mining projects, that metal won't hit the market until 2035 plus. Fifth, the dollar is devaluing. This is mathematical certainty. $36 trillion debt, $2 trillion annual deficits, no political will to stop. As the dollar loses value, hard assets like silver gain value. This is not opinion, this is monetary physics. Sixth, the paper silver market is dying. ETFs are experiencing redemption problems. Futures traders are demanding physical delivery instead of rolling contracts. The entire fractional reserve system that allowed banks to sell 100 ounces of paper for every 1 ounce of physical is collapsing. As that system dies, the real price based on physical scarcity emerges. And that price is much, much higher than 70 cents. Seventh, regional pricing divergence is accelerating. The spread between COMEX and Shanghai Tokyo is widening, not narrowing. This tells you the market is fragmenting into local supply zones, and in zones where physical is scarce, prices will reflect that scarcity regardless of what COMEX says. Eighth, governments are waking up. The Pentagon's $7.4 billion silver smelter in Tennessee is proof that the US government now views silver as a critical national security resource. They're not building that smelter because they think silver will be cheap and abundant. They're building it because they know it won't be. And when governments start hoarding strategic resources, the price only goes one direction. So when I say we're probably not going back to 70.72, I'm not being hyperbolic. I'm reading the evidence. And the evidence says the floor is rising rapidly. What was the price yesterday might be the low price forever. This is how bull markets work. They don't give you comfortable entries. They force you to either get in or get left behind. Now let me address the counter argument because I want you to have the full picture. Could silver make one more dump to $70? Yes, it's possible. If there's a coordinated attack by the COMEX and the bullion banks to trigger one final mass liquidation, we could see one more spike down. But here's what you need to understand. If that happens, it will be bought so aggressively by Asia and smart money that it will reverse within hours, not days. And you probably won't be fast enough to catch it. The risk-reward of waiting for $70 versus buying at $77 is completely asymmetric. If you wait for $70 and it never comes, you miss the entire move to $100 to $150. If you buy at 77 cents and it drops to $70, you're down 9% temporarily before it reverses and goes to 100 plus. Which scenario is worse? Missing a 100% plus gain to avoid a 9% temporary drawdown, or taking the 9% temporary drawdown risk to capture the 100% plus gain? Any rational investor answers this question the same way. Buy now, hold through volatility, don't overthink it. This is not day trading. This is positioning for a multi-year super cycle. The exact entry point becomes irrelevant over the time frame we're talking about. Let me give you the action plan because I don't want this to just be information. I want this to be actionable. If you don't own silver yet, buy physical now. Coins, bars, whatever you can get. Yes, premiums are high. Yes, delivery times are long. It doesn't matter. Get the metal. The premiums you're paying today will look like nothing when silver is at $150 and dealers have no inventory at any price. If you own silver, hold it. Don't get shaken out by volatility. Don't panic if we get one more drop. Remember, China is buying every dip. The Pentagon needs the metal. Industrial users are desperate for supply. You're on the right side of the supply-demand imbalance. Be patient. If you're trading paper silver, convert to physical. The counterparty risk is too high. The COMEX default risk is real. When the system breaks, paper holders get cash settled at the old price, while physical holders participate in the repricing. Don't be on the wrong side of that event. Watch the $84 level obsessively. That's your signal. When we break it with conviction, add to your position if you have capital. That's the green light for the next explosive leg. And don't use leverage. Don't trade with margin. This market is too volatile. You'll get liquidated on a wick and miss the move. Just own physical or fully paid positions and hold. The question I opened with was, do you want to be on this train, or do you want to fill yourself with frustration while everyone else goes to the moon? This is a personal decision. I can't make it for you, but I can tell you what I see. I see the biggest supply squeeze in modern commodity history unfolding in real time. I see governments panicking about access to strategic resources. I see China executing a multi-decade plan perfectly. I see technical setups that occur once in a generation. And I see a price at $77 that will look like the opportunity of a lifetime when we're at $200. But you have to make the decision now, because the train is leaving the station, the rocket has launched, and 2026 is the year of silver. This is not hype. This is not clickbait. This is the cold, hard reality of supply and demand meeting at a critical moment in monetary history. Good morning. Today is January 9th, 2026. The silver rocket has launched. The question is, are you on it?